Okay, so we're good to go. So we are we're on slide 17 of handout number 10. So picking up where we left off. And in our handout, problem 10 is asking us about the purpose of subsections 1321.2, 1412, 43.4, and 43.6. So right off the bat, we can ignore subsection 1412 because that's effectively been repealed as a result of the shift from the eligible capital property regime to cost 14.1. So we can ignore that. We can also ignore subsection 1321.2 just in the interest of time. Basically, what we can say is that it does the same thing as subsection 43.4, but just for depreciable property rather than for non-depreciable capital property. So effectively, we're going to talk about subsection 43.4 and 3.6 in the first part of problem 10. So what all of these provisions that are listed are, they're all stop-loss rules. And they function for a purpose similar to the superficial loss rules that you would have talked about in baby tax. Their purpose is to prevent the acceleration of losses within corporate groups on internal transactions where ownership of the property with the accrued loss simply passes from one member of the group to the other. The losses that would be realized to which these provisions apply do not get denied, but rather they generally get suspended so that they will be realized by the person who is disposing of the lost property at the point in time that the ownership of the lost property passes to somebody outside of the economic group. So like I mentioned, subsections 43.3 and 3.4 are the rules that apply to non-depreciable capital property with accrued losses. And subsection 43.6 is a similar rule, but it applies in very narrow circumstances to share repurchases. So if there's an accrued loss on shares that are being repurchased, then that's where 40 sub 3.6 could apply. So, and I think that's good for that first part of the question. And then the problem goes on from there. We need to next know about affiliation because all of the stop loss rules effectively work off of this concept of affiliation. So the slide is asking us, well, okay, when are persons affiliated? And we talked about this earlier in the course in our unit on relatedness and association and arm's length Young's. We did talk about association a little bit. So this is hopefully mostly a refresher that people are associated when they have a relationship that's described in subsection 251.11. The requirements for affiliation are much more stringent than for relatedness and for associations. So the classes of persons who can be affiliated with one another is relatively narrow. So for example, parents are not affiliated with their children, and siblings are not affiliated, even though they would be related for almost all income tax purposes. A difference between the relatedness rules and the affiliation rules as well, which is less of a difference than with the association rules, is that there are actually rules that would provide for people being affiliated with partnerships and with trusts, whereas the rules for relatedness generally don't deal with partnerships and trusts. And so you're just left to trying to patch something together based on the context of the provisions that you're dealing with in those situations. So for the purposes of this slide and the next slide, and basically whatever else we have left to talk about in this course, we really care about paragraphs 251.11 A, B, and C. So simplifying very greatly what these provisions do, they provide that an individual is affiliated with his or her spouse, that a corporation is affiliated with the person or with the affiliated group that controls the corporation, and that two corporations are affiliated if the people who control the corporations are affiliated with one another. Obviously, a corporation that controls another corporation is affiliated with that other corporation. So what I think you can tell just sort of intuitively is that this reliance on affiliation, that the definitions of affiliation in turn require affiliation between groups, make these concepts very narrow. So it is relatively difficult to be affiliated with somebody. Interestingly, for this purpose, subsection 251.13 actually defines control, instead of being de jure control, as being de facto control, because it has the in it, directly or indirectly in any manner, whatever language. So you could be controlled, or you could control a corporation if there's de facto control, or if there's de jure control, since de facto control necessarily includes de jure control as well. So that's not enough, though, if you're dealing with affiliation in real life, because there's a couple of pretty important points. One is that many of the provisions of the Act that deal with affiliation, where affiliation is relevant, also provide at the same time that the definition of control in subsection 251.13 is to be read without the reference to de jure control, or just read without the reference to that definition entirely. So the Act actually turns off the de facto control definition for a lot of purposes anyway. So for a lot of places where you might care about affiliation, it really is a de jure control test anyway, because the word control will just end up having its ordinary meaning. And moreover, the CRA has indicated that they will apply the GAR in circumstances where you do some kind of a tax plan that requires parties to be affiliated with one another but not related to one another, which is one of the places where the difference between de jure control and de facto control might be most relevant. So again, it's pretty hard to actually make much use of that expanded definition of control in the affiliation context. So with that, we can go back to our next question on the slide, which is asking when subsections 43.4 and 3.6 can apply. And so subsection 43.4, if you have opened your Act and taken a look at that provision, you'll see that it's an operative provision. It just does things. It doesn't really say when it applies or does not apply. Subsection 43.3 is the conditions of application of subsection 43.4. So that's where you have to look. So in essence, paragraph 43.3a requires that a taxpayer other than an individual, so that's an important point, dispose of non-depreciable capital property in a transaction other than on a change in use, the expiry of an option, the disposition of a debt of a related person, a transaction where the loss would be denied because of a loss restriction event, or a transaction that preceded a person becoming or ceasing to become tax exempt. So number one, that's a lot to keep straight. Number two, the reason why a lot of these things are carved out is either because there's a different stop loss rule that would apply in those circumstances, or because there's for good policy reasons, we want there to be a loss in those circumstances, because that might be the notwithstanding there may be a disposition to an affiliated person, that may be the only transaction and the only opportunity for that loss to be realized. So having a stop loss rule apply doesn't make a bunch of sense. From there, we have paragraphs 43.3b and c, and what they require is that a person who's affiliated with the transferor who wants to realize the loss has to acquire the same property or an identical property within the period beginning 30 days before the disposition date and ending 30 days after the disposition date, and that either the transferor or the transferee has to own that property or identical property at the end of that period. So these are basically the same conditions of application in paragraph 43.3 B and C that you saw with the with the superficial loss rules from baby tax. So if you've met all of those conditions in 43.3 A, B, and C, so you have a transferor other than an individual disposing of property in basically just some regular type disposition, and you have an affiliated person acquiring the same property or an identical property within the period beginning 30 days before the disposition and ending 30 days after the disposition, and the person still owns the identical property at the end of that 30-day period after the disposition, then subsection 43.4 can apply. Subsection 43.6 is much simpler because if you take a look at that provision, it looks quite complicated, but there's a giant parenthetical exclusion built into subsection 43.6 that deals with foreign affiliates. And so again, way beyond the scope of this course, and so we can just ignore it. So if you ignore the language in subsection 43.6 that we don't care about, it requires a taxpayer to have disposed of a share to a corporation that remains affiliated with a taxpayer after the disposition, and the share disposed of be a share of the corporation to whom the share was disposed. So having regard for subsection 84.9, which deems a person whose shares have been repurchased to have disposed of the share to the corporation, subsection 43.6 basically applies only on a repurchase or a redemption of shares by a corporation, and only if the person whose shares are redeemed, acquired, or canceled remains affiliated with the corporation after the conclusion of the transaction which the shares are repurchased. So from there, we now have enough background information we can actually deal with problem 10. And so in problem 10, we have individual C who's going to transfer a non-depreciable capital asset to C Co. At the time of the transfer, C owns 51% of the voting shares and C's spouse owns 49%. This transfer is effected under subsection 85.1 and is recorded as follows. Non-depreciable capital property, ACB of 1,000, disposed of to C in exchange for preferred shares of C Co with a fair market value of $500 and an elected amount under subsection 85.1 of $500. So this is non-depreciable capital property, so we know it's a good asset for subsection 85.1 purposes. We also see that because there's an accrued loss on the property, we also see that the elected amount, that's a good elected amount. So let's assume that subsection 85.1 applies here as intended. And so what would normally happen is that our individual C would have realized a loss on this, would have realized a loss as a result of this transaction. However, obviously we're asking the question after this long diatribe about stop loss rules, because that is not what actually is going to happen in this circumstance. So here we see that our individual C has de jure control of C Co. And so subparagraph 251.11B1 will apply and will deem C to be affiliated with C Co. Unlike relatedness or, most importantly, association, there's nothing about group concepts and deeming groups to control concurrently in the affiliation context, so we don't need to worry about C's spouse. This is all about C, because C by him or herself has de jure control over C Co. So it's clearly an affiliated corporation because individual C by themselves controls the corporation. So C has disposed of a non-depreciable capital property to an affiliated person in circumstances that are not described in paragraphs C to G of the definition of superficial loss in section 54, which are the carve-outs for the suspended loss rules. So that's fine, but our individual C is not a person other than an individual. because individual C is necessarily an individual. You can't be both an individual and not an individual. So that doesn't work. And so the suspended loss rules don't apply. So that's relatively straightforward. So you'd say, okay, well, that's cool. So maybe C gets a loss. And the answer is still no, because we just go back to, again, the superficial loss rules that we would have learned about in baby tax. And so what happens here is that C's loss just gets denied because it's a superficial loss. And that's the end. What will happen is that under paragraph 53(1)(f), our corporation CCO is going to get to add the amount of the denied loss to its ACB and the non-depreciable capital property. So the loss is preserved within the economic group, but it's going to be CCO's loss at the end of the day, and not C's loss. So we have a question. I'll just go to our question. Do we need to know the superficial loss rules? Because my previous tax class never covered that. Okay. Let's put it this way. In the very narrow sense of you preparing for the exam, I don't think so. I actually wrote the exam over the weekend. I don't think I had anything in there where the superficial loss rules would be engaged. So no, in the narrow sense, you do not. In the broader sense, yes, you do, because they're important rules. So let's talk about them for just a second. If people don't want to talk about that, well, that's too bad. So let's just pull up our acts here and we'll grab our definition of superficial loss. So this is in section 54, the definition of superficial loss. It's probably faster on an actual paper act than on an iPad, but such is life. All right, so our definition of superficial loss, if we have turned our way to section 54 and found that definition, what we're going to see is that basically a superficial loss requires that you have a taxpayer dispose of a property at a loss, okay, and during the period that begins 30 days before the disposition and ends 30 days after the disposition that caused the loss to be realized. So this is effectively a 61-day period. The taxpayer or a person affiliated with the taxpayer has acquired a property that is either the property disposed of or is a property that's identical to the property disposed of. And the Act does have some idea of, does talk a bit in place about what an identical property means. This is in subsection 248.12. If you want to go to that definition, have a look at it later. But basically, why we have this concept of an identical property is for things like securities, where your shares of Bell, let's call them, are fungible property. Any shares of Bell you acquire off of the exchange are exactly the same. So we have to have this concept of an identical property, recognizing that it may not be exactly the same. And so that was condition number one. Condition number two is that at the end of the period, the taxpayer or the affiliated person has to still own the identical property. So if you satisfy those two conditions, then you have a superficial loss. Now, what you're going to see is that there are a bunch of carve-outs built into the superficial loss definition. For example, things that would be suspended losses under subsection 43.4 are carved out. Things that would be losses on debts of related persons under paragraph 42E.1 get carved out, etc. So the effect of all of these carve-outs is basically that the superficial loss rules really only apply to individuals and not trusts, actually. So just regular old-timey individuals are the people to whom the superficial loss rules can apply. And so if you have a superficial loss, as defined in section 54, Then what happens is that the amount of the loss is deemed by subparagraph 42G1 to be nil. And so that's part one. And then so the transfer's loss is deemed to be nil. And then part two is that the transferee's ACB in the property is deemed to be increased by the amount of the denied loss under paragraph 53(1)(f). So those are the superficial loss rules. And so to use a really easy example of how they work, suppose that wife owns a bunch of shares of, again, let's say Bell, and suppose the shares have an accrued loss, and we're sitting here on December 31 of 2021. Wife has realized a bunch of other capital gains in the year and would like to realize some capital losses to reduce the tax payable on the capital gains. But wife thinks that the shares of Bell are going to increase in value in the future, and so would like to remain invested in Bell, and in fact thinks the increase in value is going to happen in the relatively short-term future. So what the superficial losses are intended to prevent is the following transaction. Wife sells Bell shares, receives cash, realizes capital loss that will offset some capital gains from other sources. Wife gives money to husband. All of this happens on December 31st. Husband goes onto the exchange and buys an equivalent number of Bell shares using the money. And then, the Bell shares, as expected, rebound in value. And so now, as a result, the loss has effectively disappeared. And there is now a locked-in gain on the Bell shares, but that gain may not be realized anytime soon. So that's what the superficial losses are intended to prevent. If you did that in real life, then what would happen is that the loss on the Bell shares realized by wife would be deemed to be nil. Husband would have an addition to the ACB in his Bell shares equal to wife's denied loss. And so this basically the situation would be the same as if nothing had ever happened, just that there's been a transfer of the shares from from wife to husband. So those are the superficial loss rules. So now you know. All right, anybody else before we move on? Okay, seeing nobody, let's flip to the next slide. So this is slide 18. And we have some different rules, and these are largely dealing with depreciable property and transactions involving depreciable property, which we talked a little bit about last week. So the first question that we have in problem 11 is asking about paragraph 13.7e. And what 13.7e is it's effectively, you can think of it as an anti-avoidance or an anti-arbitrage rule. And what it does is it creates it prevents the creation of UCC through the realization of capital gains. And so the reason for this is that UCC can be used to take CCA deductions, and CCA deductions can be used to shelter, ordinary income from tax. And so since capital gains or capital losses are supposed to be, kind of different, and since capital gains are only 1/2 taxed, then we don't want to have people realizing half-taxed capital gains that might be offset with capital losses in order to create UCC that can be used to generate CCA and take deductions against income from other sources. So that's what we're trying to prevent. And this, this is a material enough concern, right? That notwithstanding we have other rules that, involve the creation of UCC and the restricting the amount of CCA deductions that people can claim in certain circumstances. There are real concerns here, right? Especially right now where we have advanced CCA deductions or enhanced CCA deductions in order to try to compete with the 2017 US tax changes. You might be thinking to yourself, well, why would you ever pay tax in order to get a deduction over a number of years? But when you're basically getting to write off all of your assets at a very accelerated rate, it might make actually quite a great deal of sense to realize a capital gain on an asset, pay tax on the 1/2 tax capital gain. And then if you're getting, for example, a 50% deduction against your income in the current year, it could make a lot of sense to do this, right? Especially when the time value of money is not especially high. So having deductions over, perhaps 2 or 3 years against ordinary income might be all that it takes to even you out. So, something that we do want to prevent. Part 2 of the problem then asks about our actual problem in problem 11. And so in this part, we are assuming that an individual A disposes of a depreciable building, I mean, they're all depreciable, but whatever, to her wholly owned corporation at fair market value, which is $200,000. A's cost in the building is $100,000, and the UCC at the time of the transfer is $90,000. So here, what would happen, on this FMV transfer, is that A is going to realize $10,000 of recapture income, which is the difference between the UCC and the capital cost of the property. So that represents depreciation deductions already taken that are being recaptured, and then a $100,000 capital gain on the sale of the building to ACO. And obviously, because A controls the corporation, A therefore is related to the corporation under paragraph 251 2B1, and therefore does not deal at arm's length with the corporation under paragraph 251 1A. So ordinarily, what would happen is, but for paragraph 13.7e, ACO would have a cost in the building of $200,000 and would add $200,000 to the UCC of the building and would then depreciate the building based on that cost. So interestingly, this is actually not a transaction that people would normally do in order to create CCA, because the buildings generally don't qualify for the accelerated depreciation, and the CCA rate for a building is like 4%. So you would never actually do this, but let's just roll with it because it's an easy example. So what actually happens here, though, is that because ACO has acquired the depreciable property from a non-arm's length person, and that the depreciable property was capital property of individual A, paragraph 13.7e does apply. And so since A is an individual and ACO's capital cost, otherwise determined, of $200,000 exceeds individual A's capital cost of $100,000, subparagraph 13.7e1 applies to the acquisition. And where paragraph 13.7e1 applies, it provides that ACO's capital cost of the property shall be equal to A's capital cost of $100,000 plus one half of the amount, if any, by which A's proceeds of disposition of $200,000 exceeded her capital cost of $100,000. So basically what this is saying is that for the purposes of section 13, section 20, and the regulations, individual ACO rather's capital cost is going to be equal to A's $100,000 capital cost plus $50,000, which is 50% of the difference between A's proceeds of disposition and A's capital cost. So the idea here is that you only get to add to the UCC of the depreciable property the amount, you only get to add to the UCC of the depreciable property the amount of A's taxable capital gain and not the gross capital gain. So the idea being that since no tax was paid on part of the gain, that you just don't get a UCC addition and you don't get to depreciate it. This only applies very narrowly for the purposes of Section 13, Section 20. So it's not like the capital cost is only $150,000 if ACO were then to go and immediately sell the building. ACO wouldn't realize a $50,000 capital gain because the capital cost isn't reduced for those other purposes of the Act, only for the purposes of Section 13 and Section 20. Okay, so then the problem goes on to ask what would happen if A were a corporation. And the answer is that the result would be exactly the same if individual A were a corporation. So we just had a transfer from BCO to ACO, and BCO and ACO were both non-arm's length persons. Exactly the same result, except the governing provision would change. So instead of having subparagraph 13.7(e)(1) apply, we would have subparagraph 13.7(e)(2) apply. And the reason why these two provisions are separate, why we have a different rule for corporations and for individuals, is just a remnant of the pre-1995 $100,000 lifetime capital gains exemption for individuals, where you could just dispose of any property you wanted within some very unreasonable limits and just exempt up to $100,000 of capital gain. So because we had that particular situation where individuals could have capital costs in the property, as a result of just an exempt disposition, or could have full proceeds of disposition but could just exempt the capital gain from tax. In that case, we needed a separate rule in paragraph 13.7(e). So one would hope that over time, as we get further away from 1995, when some of you might not actually have been born yet, the further we get out from 1995, the less compelling the rationale is for those two subparagraphs being separate, and maybe at some point they'll get consolidated back into a single provision. But that's why they're separate. But the result is exactly the same in substantially all circumstances. Then the problem goes on to ask, okay, well, what happens if this was a transfer under subsection 85(1) and A's elected amount were equal to the UCC of the building? And so the answer is that, again, paragraph 13.7(e) could apply, but it wouldn't do anything because the formulaic amount just wouldn't arise. So the reason that this would happen is that having regard for subsection 85(5), if you did this on a tax deferred basis under subsection 85(1), the proceeds of disposition would be equal to the UCC of the property, but ACO would be deemed to have capital cost exactly equal to individual A's capital cost and to have claimed the other $10,000 as depreciation in prior taxation years. And so you would just be in exactly the same spot. So there's no reason for paragraph 13.7(e) to apply to actually do anything. And then finally, the question asks, well, what happens if the elected amount is $150,000? So instead of electing all the way up to fair market value, individual A and ACO just elect halfway up the range at $150,000. And so the answer here is that we're back into subparagraph 13.7(e)(1) as a result of this election, because again, now we have a situation where subsection 85(5) is inapplicable, all right, because we've elected to realize our recapture on the building, so we don't need to worry about subsection 85(5). And ACO's capital cost is going to exceed A's capital cost. A and ACO still do not deal at arm's length. So what will now happen again is just like before. Paragraph 13.7(e)(1) is going to deem the capital cost of the property and therefore the UCC addition in respect of the property to be equal to A's capital cost in the property plus 1/2 of the proceeds disposition in excess of the capital cost. So here we have $50,000 of proceeds of disposition in excess of capital cost. And so the result should be that there is a $50,000 capital gain, and so 1/2 of that amount, or $25,000, gets added to the capital cost. And so for the purposes of computing CCA deductions, the capital cost of the property is $125,000. So that is problem 11. Did anybody have any questions there before we move on?
I have a question, but it's not exactly related to this specific problem. It's more just about when you are realizing your range. Like, how do you know which one is your maximum amount?
So this is so paragraph 13.7e. Kind of, if it did apply to the corporation, it kind of tracks back into section 85 if there was a subsequent transfer, in that it would cause the UCC to be less. So you would have to account for that. But if you'll recall that for depreciable property, your range is always going to be, have the 3 elements, which are going to be the cost of the non-share consideration, the fair market value of the non-share consideration, rather, the fair market value of the property as potentially a lower bound or potentially an upper bound, depending. And then because it's depreciable property, you're going to have an elected amount at the greater of your UCC, your capital cost of the particular asset, or the fair market value of the property. So again, if you've got depreciable property as being transferred to the corporation, you will need to just be able to identify what the capital cost is, what the UCC is, and what the fair market value of the particular asset will be. The capital cost for these purposes of paragraph 13.7e applies. It does not apply for the purpose of capital cost in applying section 85. But where it can show up is that because it will cause a lesser UCC addition, because the amount of the UCC, the amount of the capital cost for the purpose of the UCC addition is less, it will show up in that reduced UCC. So generally speaking, if in our example, ACO were to subsequently transfer the property to another corporation under section 85 on a corporation to corporation transfer, the UCC is always going to be less than the capital cost of the property. So we're going to have the lowest amount in our example of ACO that immediately went and transferred the property would be the UCC, because the capital cost of property will be higher than the UCC, and the fair market value of the property will be higher than the UCC. So we would have our lower bound at the UCC of the class that includes this building.
Okay, that sounds good. And then I just had one more question. How do you know that they've elected to realize the recapture of the building?
So that would just happen kind of by operation of law, right? That if you elected above the UCC for the class, so in this case we're dealing with the billing. So billing is the only asset in the UCC cost, and that makes it nice and easy. If you elect at an amount that's higher than the UCC of the class, then every dollar between that UCC balance and the capital cost of the property, that's going to be recapture under subsection 13.1. That's just going to be the result, and so you just know by operation of law that that's what has happened.
Oh, okay. Thank you.
Yeah, no problem. Anybody else? Okay, seeing none, we can switch over to slide 12, to slide 19 and problem 12. And problem 12 is dealing with section 22. And it's asking about section 22 and what its purpose is. So section 22 is a provision that deals with the AR on the sale of a business. So this is really a review for those of you who are accountants, but for an accrual-based taxpayer, which is almost all taxpayers, right, other than farmers and fishers, basically everybody is an accrual taxpayer. For accrual taxpayers, accounts receivable are usually included in income in the year that the invoice is sent to the customer. So if a business is sold and the outstanding AR is assigned to a buyer, then you have this problem where the person who would collect the cash, which is the buyer, and the person who has realized the income inclusion, which is the seller, are different people. And so this is what Section 22 is intended to avoid. So Section 22 applies if a taxpayer carrying on business has sold all or substantially all of the property of the business, including the AR, to a buyer, and the buyer will continue to carry on the business, and the parties jointly elect for Section 22 to apply by filing CRA Form T2022. And so basically what Section 22 provides for when it applies is that to the extent the purchaser did not pay cash for the AR, the seller may deduct from its income an amount equal to the amount that was included in income in relation to the AR, and the buyer will have to include a corresponding amount in the buyer's income. And then for the purposes of bad debt deductions and allowances for doubtful debts, the buyer is treated as though it were the vendor. So as though it were the person who had originally sold the property or provided the services that gave rise to the AR. So that's Section 22 at a very high level. You will see that from time to time, although generally on asset sales, I'd say more often than not, you will have the seller will retain the AR and they'll have to collect it themselves. But sometimes the buyers do buy it, and sometimes you will make a Section 22 election, but it doesn't happen with great frequency. Where you might see it in Alberta, especially, is on the incorporation of a farm business. You might, well, I mean, you wouldn't even necessarily need to do it there because it's cash basis. But in a situation where you've got the incorporation of a business and you have a bunch of AR and you would like to pay tax on the AR at small business deduction rates, you might see a non-arm's length Section 22 election on the incorporation of the business. That would be somewhat common, but not all that common. So then the problem goes on to ask, how does this tie into Section 85? And there's no statutory tie-in is the answer, right? There's no statutory tie-in of any kind between subsection 85.1 and Section 22. However, when you see a business being incorporated under subsection 85.1, it is likely that the AR of the business is going to be transferred to the corporation. And so, like I just said, you may see an election under Section 22 in those circumstances. The important thing that you have to realize that the tax consequences of earning income on an accrual basis cannot be assigned to the corporation by making a subsection 22.1 election. So if again, like I just said, if you're going to incorporate a business, making the Section 22 election can be very beneficial because you could cause the AR to be taxed at small business deduction rates by having the deduction for the vendor and the offsetting income inclusion for the purchaser. So that is somewhere where a Section 22 election could make a bunch of sense. So that's all I wanted to talk about in Unit 10. Did anybody have any questions about Unit 10 before we move on? Okay, seeing nobody, this is probably a good time to take a break before we jump into Deck 11. So I'm going to stop recording.